So with emerging markets and developed markets, mature markets, and what is happening with EMs in general, and then how does this feed into Europe? So the emerging market, the average interest cost of outstanding government debt is going higher for emerging markets. And we think that actually, you can see that the slope is fairly controlled. We actually think that this really turns higher, especially as rates go up in the US. And it's going to be a mixed bag because rates in the US, GDP will that slowdown will help kind of cap it, but obviously inflation and rates going up. But as the Fed stops buying so many treasuries, that's where we think you're going to get that real rate increase, which is going to put pressure on emerging markets. And mature markets, we believe, flatline a bit more and actually start to creep higher, which is why when we look at EM local bond yields versus EM inflation, they're all shifting up. And we think that is really going to pull up that emerging market interest expense and interest costs as they look to roll, as they try to grow. This is going to become a huge problem when we look at global growth and especially emerging market growth through not only just, I think, 2022, but really into 2023 as well, where emerging markets remain our biggest concern. And now when we look at Eurozone and what has happened, so industrial production, right in line with expectations for October, that slows a bit in November, but still in line. Now when you look at Eurozone manufacturing, expected at 57.8, came in at 58, which again, we were expecting manufacturing to be a bit stronger, but services missed. It was expected 54.3, came in at 53.3. Bringing the overall composite down from 54.4 to 53.4. And that is the biggest issue because as COVID continues to spread, coronavirus, Omicron in general, it's not that you're going to get this huge shift in spending. It's just people will try to do a bit less. And I think that's really starting to play out on the services front as the ECB maintains current rates, but we're starting to see some pace of slowdown, which we'll talk about in a minute. So then when you look at the Eurozone real wage growth, it's getting annihilated, and it's because there's no wage growth and inflation is rampant across the Eurozone. So again, this is also going to lead to the pressure in services and eventually in manufacturing as wages just aren't keeping up. And you're seeing, again, that inflationary hit and those pressure points really start to feed through. And then the Germany wholesale price index, again, giving way to inflation. Year over year, it's at 16.6%, blowing through all levels, and wholesale price index is going to continue to go up. We think the pace slows a bit, but again, you're just seeing we're not reversing lower, we're still going up, which is going to be, I think, the underlying pressure point. And then when QE slows next year, the question is going to be by how much, and we see it being a fairly muted response, but we think that accelerates in Q2, just because I think very similar to what the expectations are here, because inflation is just running rampant, and they're going to try to get in front of inflation, just like a lot of central banks. And the ECB was actually first, and well, I shouldn't say first, but when you look at raising rates, South Korea was first, and Canada, but I think you're going to see some additional and more aggressive policy shifts and hawkish moves as we go through go into Q1 and Q2 of next year. And here's why. So CPI in Germany cooled for a touch. It fell negative 0.2% was the estimate, came in at negative 0.2. But when you look at year over year, is at 5.2%, and we just see that again that reacceleration of inflation. And if you remember, in October, we expected a slowdown, rate, and then we expected acceleration in November. Europe is about a month behind us for some reason in a lot of this, so that's why we got, I think, that slowdown, and now they'll get the acceleration, just like we got the acceleration now. And it's really showing up in wholesale price increases. And then when we look at manufacturing in Germany, so German manufacturing was expected at 56.9, came in at 57.9, but Germany services was expected at 51, came in at 48.4, so now in full contraction, bringing the composite expected at 51.1 just to 50. And we think that a lot of that continues to play out, again, due to real wages, consumption falling, COVID issues, and again, that's going to result in a much slower Europe than what people are expecting, which is, again, what we've been calling for. Now, German exports were higher. German exports have cooled off a touch in November, but still remaining elevated. Again, they are an exporting nation, which is part of that manufacturing strong point, but the consumer continues to be the underlying problem. So then when we flip to France, you can see here that the CPI was right in line with expectations. We don't see that adjusting. Business confidence slightly lower than expectations at 110, but realistically, everything fairly in line. Manufacturing PMI was expected at 55.4, came in at 54.9. Services PMI was expected at 56, came in at 57.1. So France has the exact opposite of what's happening in Germany, where manufacturing was slower, services better. Germany, manufacturing better, services slower. And that's brought the composite, was expected at 55, brought it in at 55.6. So France and Italy still remain the brighter spots. France is kind of a mixed, right in line, but Germany, slowing as they are, is really the bigger overhang, especially given the size of the country, the percentage and what it means for the underlying economy, as an aggregate Eurozone, which I think is the problem going forward. So again, those are some of the pieces. There's not as much to talk about this with Europe. We'll have a bit more next week, but even still, some of the the data is drying up. So we'll have a little bit shorter shows, thankfully, as we go into year end and let everybody get to their holiday a bit faster. So now in the next segment, we're going to go to Asia and some of the things that are happening on that side of the world.